So I just had probably one of the worst drawdown periods of my life trading, and this was after a fucking crazy green streak. So here you guys go. So yeah, I mean this month in June made almost 5K, and then the next month after minus 1.7K. Yep. And the crazy thing is, I knew that this was gonna happen because I knew that we were trading in low probability conditions, but I kept on forcing trades, sizing up on them, and that's how I got these super big losses, right? And this count's almost fucking blown because I said to size up after a payout. And is this possible to climb out of? Maybe, maybe not. But point is, I'm trading like a fucking idiot. This account, I lost a funded account recently, and then yeah, then this is almost, I mean, this is probably doable for a payout, but yeah, it doesn't feel great going this loss streak. But the thing is, people want to argue the markets are random, but if the markets are truly random, I would not have foreseen this streak of losses because I told like if you guys check my IG, that's where I'm more keeping keep people more up to date there. I'm like, all right, guys, we're trading in the middle. Like, this is low probability conditions, but my dumbass was trying to do the harder thing as a trader, and I was trying to trade from the middle to the extreme. And so I decided that I'm not gonna let this drawdown period make me quit my strategy because my trading strategy tells me where I'm more likely to fail, and that what strategies truly do that for you, right? And the next thing is that am I really just gonna let this trading strategy define me as a trade or this drawdown period define me as a trader? Like, am I just suddenly unprofitable now? Like, am I just a shit trader now? No, that's just not the case because I understand the concept of fair value, and I'm gonna explain it to you guys in this video um, on how supply and demand trading works and how you can use this concept to avoid the future drawdown period. Because I guarantee you guys now, you guys, yeah, like I'm being very transparent, like where I'm taking these losses, but that's because I'm still developing as a trader myself, and guaranteed, next time we're in this condition, you guys aren't gonna see the same trader as you guys did today. Like, yeah, this the Jason today, he fucked up all his trades in fair value, but give me a couple months, I'm not trading this area, and if anything, if I do trade in this area, I'm gonna fucking do it successfully. So, anyways, here's the concept of fair value. Let's get straight into the sauce. So, fair value, I'm going to talk about the theory and the application of it on the charts. Let me make sure I have charts ready. Okay, I do. All right. So, fair value. The markets become efficient in this area because this is where the most trading activity happens. This area where the most trading activity happens and the most volume uh, and trading activity occurs, this is where price usually wants to gravitate to because the market is a constantly evolving supply and demand equation, and fair value is not static, it's always moving, right? But fair value also determines where price wants to gravitate to because the market naturally just wants to be in a state of balance, correct? And the markets want to be in a state of balance because that is where it can do the most trading activity. That's where it can conduct the most trading activity because the markets always want to be efficient. Imbalance is not good because that implies that there is a significant imbalance somewhere in the supply and demand equation, and there's a significant imbalance. The market naturally wants to correct that. Equilibrium is something that economists and nature, like, and people, animals, they're always trying to achieve. So it makes sense that naturally, when there's something that involves buyers and sellers, fair value is going to be a spot that the markets are a state that the markets are trying to achieve, right? And you can see this wherever there's a lot of trading activity, consolidation, and volume. And trading wise, it's low probability. Like, why should you expect something that trades like this to give you a very clear long setup? Like, if you choose to long right here, thinking price is going to go right here, yeah, obviously you're going to stop down, and then after you get stopped out, you're thinking, oh, maybe price is actually bearish. So you go take a short here, expecting price to continue going down. Nope, stops you out again. Like, this is not a this is not a high probability area of trading. Now imagine if you were trading somewhere here in a demand zone where prices are cheap at $5 when it's usually trading at $10 and the high is $15, right? if price for whatever reason decided to shoot down to $5, everyone should be buying here. But the thing is, not many strategists can clearly define where the market wants to gravitate towards to. And fair value is where the markets want to gravitate towards to. And by using that information, if $10 is where the market usually spends most of its time at, why should you not expect $5 to be a temporary price point? That's the key thing right there. $5 is like the temporary spot where you shouldn't expect price to stay there that long if the majority of the trading activity has happened at $10, and you can see it objectively on the charts, right? So when price enters $5, now you have a high probability trade setup. Now you can see $5 is where everyone wants to buy, and if you can be a buyer right there, you should expect price to just shoot back up to $10. And then if price were for whatever reason to shoot up to $15, you should see that the supply zone here, prices are expensive, everyone should be selling here, right? And if you do sell for $15, you should expect to be able to buy it back for $10, okay? That's how you would apply this. So yeah, what determines fair value? You can turn on the volume profile chart, and you can see that fair value is literally, I know there's a drawing for it somewhere. Fixed range volume profile, boom. Boom. See, fair value is inside of here. If you check inside of here, there's all these different supply and demand zones. Oh, fuck. You shouldn't expect price to be imbalanced here, because if prices are balanced, then yeah, you should expect back and forth, back and forth. But when we exit fair value, that's when we find a high probability short. Like right here, we have a 4-hour supply zone that I had marked. The moment price goes into that, instant 700-point drop. And why should it not drop? If the majority of the time the NASDAQ wants to spend in 29,000 something, why should it not drop all the way down here, right? Does that make sense? So you can see this. If you choose not to use a volume profile chart, you can, how the fuck do I zoom out here? Oh, there we go. If you choose that to not use any indicators and just go completely naked, then you can just look at the price action. Where does price do the most back and forth? Or you can just have your supply and demand zones marked, right? This is number 3. Have your supply and demand zones marked, and then whatever's in the middle here is most likely fair value, because this is where price usually wants to invalidate a lot of supply and demand zones. And if price is in the middle of these supply and demand zones, you shouldn't expect prices to be imbalanced here because it's in the middle. So you really can use the term fair value interchangeably. If you want to be concise, there's different words for it, but again, there's different ways to identify it, and regardless of whether fair value has been created or not, the third way to see fair value, the supply and demand method, that's how you can kind of predict where fair value wants to be. Like if this was 4-hour supply, like even before all of this happened, you could have implied that fair value was going to be over here, because this is where the only quality supply and demand zones were. So if these are where the only quality supply and demand zones were, then price has to have a middle there for these to be quality zones. So you could have predicted that fair value was going to happen in here, regardless of, or not, whether more volume was built or more back and forth action happened. So that's how you can predict fair value. But if you're looking at past activity, then yeah, you're going to look at where the most volume happened or where the most back and forth happened. Like this is another area of fair value. So if you look at this, when prices went below fair value here, it was able to shoot back up and through fair value until prices got expensive again. And literally right here was where all-time highs was, because new buyers decided to step up around here. I guarantee if I zoom in, I could find a demand zone. There's probably one in the 1 hour here. You know what? Just to prove a point, I'm going to do it real quick. Go to 1 hour, and I'm going to see if I can quickly see a demand zone. That's a demand zone. But what's a spot you could have actually entered at? Probably not right there. Right here? Yep, right here. I'd say right here is the demand zone, and if you used a wider variation, shit, even if you don't use the wide variation, you still would have had an entry. Boom. See? Because a new buyer popped up right at all-time highs and there were no sellers to be present, you could kind of assume that fair value was around here, and if price were to hit back up here, we would continue going up. That's pretty much what happened, especially if you used a wider variation. Right there. So yeah, there's an example on the charts there, and yeah, the three things you should be, three things that you should take note with fair value and how to actually use it on the charts is that fair value is where price wants to gravitate towards. So if you find a short entry up here, you're gonna want to short it all the way back down to fair value. So if you take a short here, you want to have your exit your shorts around here. And this is why swing trading is kind of useful, because you can hold overnight, because this move happened overnight and you would have got a shit ton of fucking points had you just traded between halfway or shit, maybe all the way to the other side where demand was, right? You have all these high opportunistic profitable setups that occurred just by entering supply, right? And yeah, fair value is just a price that is where price wants to gravitate towards. So when you're above fair value, that's where prices are expensive, and that's where you should look for high quality supply zones to enter shorts so that you can take advantage of this opportunity. That's pretty much what I did all of June. We were moving from one side of fair value to the other side of fair value in like a day or two, and that's why I was able to like play both sides and consistently make money, because when price is imbalanced, you're pretty much just gonna have a trend day. So all you gotta do is get on the right side of the trade and hold your trade. When prices are above fair value, this is expensive. When prices are below fair value, prices are cheap. So when prices are cheap, think buy. When prices are expensive, think sell. Mark out fair value in the middle. Yeah, when prices are above fair value, you can see here I had a 4-hour supply zone marked out. Fair value was implied to be in the middle here. And then you just find an entry, write it down. Simple. Look for qualities, and there are more sellers than buyers at this price. Yeah, so when you're in a supply zone, there are more sellers than there are buyers. And when you're below a fair value, that's when prices are cheap, but that's when there are more buyers than sellers. So it is not just a random coincidence that price happens to shoot up. It's not a 50-50 chance. It's none of that bullshit. Like, that's my favorite thing to say, because my friends always said it was a random guess, but it's not. The truth is, when prices are cheap, more people are willing to buy and should be buying. And when prices are expensive, more people are willing to sell and should be selling. So yeah, when prices at fair value, like this is an example here. This is pretty much what I was trading all of fucking so far, all the way up to like July 10. It's just back and forth, back and forth. This demand zone fails, this demand zone fails, this demand zone fails, this supply zone fails. Like, all these trade opportunities are just non-existent, and they're all low probability because you truly don't know where the market wants to go. And I'm not good enough of a trader to go from the middle to an extreme. I'm only good at trading from extreme to the other side of fair value to another extreme, right? That's just the easiest fucking trade to do. So it's during times like these where you enter drawdown periods, and that's when you start losing faith in the strategy. But because I've been through so many unprobable or low probability conditions with supply and demand, I've learned to trust it, because supply and demand does tell you when price, when times and price is unopportunistic. There's no edge in this area here, and I can clearly define it. If it was just a random guess where prices were unopportunistic, like if I got on the charts one day and I kind of had to just eyeball it, like, prices might be bad here, that's not a valid trading strategy to me. To me, it's a good trading strategy because I can look at the charts and know beforehand, oh, this is where the most trading activity happened, this is where the most volume happened. I should not be expecting clean price action. I have the expectations beforehand. Like, literally this entire week on my Instagram story, I was like we're in the middle, there's low probability, I should expect to fuck up here. And if I actually had listened to my pre-market plan, I'd be avoiding a lot of losses. But because I was so greedy and wanting that payout I got impatient, I overtraded, sized up when I shouldn't have. All I had to do was wait for price to go outside of this area. So yeah, putting it all together, fair value is the theoretical equilibrium price of the market you're trading. The market naturally wants to find this equilibrium point, and then the only time it's high probability that you can find a good trade is when price is out of equilibrium, and it's when prices are either cheap or expensive inside these demand or supply zones. And if you decide to trade fair value, you should expect drawdown periods, but that doesn't mean the strategy is fucking shit. There are times where some strategies are just better than others, and supply and demand is one of those strategies where, because there is the concept of fair value, it actually proves that supply and demand is a good strategy. Because if supply and demand, if every zone was good and the market was always in a state of imbalance, then we'd literally be defying the laws of physics and economy. Because if the markets naturally want to be balanced and every single trade opportunity we have is imbalanced, then we're literally, this trading strategy is not fucking real, right? But because the concept of fair value exists, that proves that there are times where the markets aren't random, because it is very predictable when price is going to be unpredictable, and that's what makes it not random. And opportunities are only found outside of fair value. And this is fractal, so you can apply this to pretty much every time frame. And yeah, if you just choose to trade this area, you're going to get drawdown, but it is a magnet for price, so use it as part of the context that you need as a trader. So yeah, I mean, that's it for this video. Fuck. Let me see if I can show another example. Yeah, if you zoom out, you can literally see I had fair value marked. Wait. What the? Maybe if I exit this, I don't know what the fuck happened. Oh yeah, here we go. Cool. Yeah, anyways, point is, this is fair value. You can literally go anywhere on the chart. You can look at this. This is fair value. Whenever we enter, like if you literally look at outside of these turning points, like right here, this is where we turned. Let's see if we can find a supply zone right here. That let's see if we can find a supply zone above fair value that proves prices are expensive here. This is a supply zone. Boom, 2 hour. Turn this all the way out. Boom, there's your trade opportunity. I wonder if we go 4 hour, we'll get a cleaner zone. No, there's no cleaner zone here. Maybe 1 hour. Okay, 1 hour does provide a cleaner zone. But anyways, point is, this is the spot, and then you can probably check even closer and see that new supply came in. This is arguably a supply zone right there. It only has one follow through candle, but to me, it's like after you're at this price point where there's such a clear fair value zone, you're kind of looking for any supply zone to work with to enter the trade, because you don't want to miss it. Because yeah, right after we enter supply, boom, big drop, big drop, big drop, all the way to the other side of fair value, and there's probably demand sitting somewhere here. Anyways, yeah, I don't want to extend this video more than it should be, so that's it.